Also, we got to talk about the FDIC. The FDIC just released its quarterly bank profile. Our very own David Hollerith is live at the press conference. Dave, you've been listening in to what they've had to say about this report. What did you take away?
Yeah, Brad. So, it's one big bad number that we're focusing on. And some of the good news, I guess, is that this is something that we've known for a while. Obviously, the first quarter was many weeks ago. So U.S. banks lost $472 billion in Q1. And when I say U.S. banks, I mean FDIC insured institutions. So that also includes saving and loans associations, as well as commercial banks. The point that this comprehensive report gives us basically is it shows us sort of what has happened outside of that big number we were kind of already aware of. One example of that is that it looks like bank deposit data has mostly, a lot of the deposit outflows has mostly been uninsured deposits. Insured deposits actually rose during the quarter. Other things we're seeing is that the unrealized losses, which were sort of another part of what caused the banking turmoil that began in March, also appeared to have been reduced over the quarter. The list of problem bank the problem bank list, which the FDIC publishes every quarter too, which is kind of a confidential list they use to show which institutions are sort of getting to the brink of insolvency. It rose by 4 banks. So from 39 to 43, and that's actually still very low by historical standards. And the amount of assets on that list is only about $15 billion in assets, which obviously sounds large. But what it means is that there's no top 30 bank in the US that is on this list. And so that was one of the big things we're looking at. So obviously this is older data that's been aggregated at a sector-wide level. So it looks bad, and we've known most of the bad stuff, but now we're starting to see a little bit more from the FDIC in terms of what actually happened. It's the most comprehensive thing we've seen. And that being said, the FDIC's chairman, Martin Gruenberg, actually, he stressed that obviously this was only a few weeks of the banking turmoil as it kicked off in March, and the first quarter ended March 31st. So he said that, second quarter bank earnings is going to also play a big role in terms of feeling out where the crisis is. That being said, it does seem as though, judging from the report, that things do seem a lot more stable. Ongoing concerns for the rest of the year, of course, is going to be the decreasing profits that banks are going to show, and that's all we're looking at from the report now. But there's tons of data.
And David, it's striking to me because we have been seeing stocks take a leg lower here for the past almost hour now, but it's financials that are leading. And even though this is backward-looking data, to your point, with this, look at unrealized losses, with the uptick in the troubled banks, it seems like that the people are maybe concerned about some of the implications of this report.
Yeah, I think that that's probably true. The big thing that I think this shows is that it's along with regional bank earnings when we first saw them, just from individual banks, it's that things are not as bad as were initially feared. So that is a good sign. But again, as I pointed out, there's all this indication and guidance from the FDIC's chair that it's going to be tougher going for the rest of the year for financials.
David Hollerith following all things around the FDIC and what they are tracking, especially around the banking turmoil that ensued mid-March. David, thanks so much for breaking that down for us.